Hello and welcome to another market update. Today is Wednesday, the 8th of November. A lot of stuff to talk about today in relation to rates and market activity and inflation and a whole bunch of things. Top three things are a question really, which is, has the cycle bottomed yet? Number two is going to be inflation and our ongoing conversation around inflation. And then finally, to have a little bit of a look at the quad outlook and what I am expecting to occur over the course of the next couple of months. Really, let's say for the first quarter of, December month and then the first quarter of 2024. So let's just kick off with the cycle and where we're at in the sine curve. So we're still headed down the slope of the sine curve in terms of the overall economic and business cycle, which means that we have further to go in relation to the economy slowing, the potential recession, and you'll see here I've got a slide from Hedgeye up, and just broadly the market coming to terms with the fact that economic data continues to slow and is poor, earnings will continue to slow and will be poor, and we're going to see continued correction in the market. And one thing I wanted to highlight in relation to that is the fact that overnight, and it was actually yesterday, China and Germany, but China reported a horrible export number, and the Chinese stock market got hammered. The Korean stock market, South Korean stock market got hammered, and then Germany also reported some really bad data, and their stock market continues to suffer. So we've got recession or bad economic data coming out of China. We've got bad economic data coming out of Europe, and Germany's one of the largest economies there. And it's no surprise that the Australian dollar went down off the back, even off the back of an interest rate rise, because if you think about it, an interest rate increase in Australia should have seen the currency go up. And the currency had moved up to about 65, a little over 65 cents to the US dollar in the lead up to the RBA announcement yesterday, but then promptly sold off and has continued to sell off through yesterday afternoon and today. And so it begs the question, what is going on with our economy? Because the currency traders know, the market is smarter than any one individual, of course. But with this data coming out of China in particular, which is one of our biggest customers for raw materials, and Europe also would be a big customer of our raw materials, it makes you wonder what is coming in the next few months, that the Aussie currency isn't holding up and in fact is being sold off after an interest rate increase. Now, perhaps one other argument that could be made is, well, if inflation is the root cause of this interest rate rise, which is what the RBA actually has sort of come out and said, is that they're concerned about inflation and want to continue to ensure that inflation is coming down. I don't know if it's on that slide or another slide. Sorry, I've just got some slides here, and in one of these slides there is actually oh no, that's the same article. There's actually an indication of what inflation has been, 5.5% or thereabouts reported in the last report. In fact, I've got that, 5.2%, which was the core inflation rate, 5.4%, which was the headline inflation rate, last reported in September of this year. And again, nowhere near the 2 to 3% target rate that the RBA and other central banks seem to have targeted. So just to close off the cycle bottoming part of this conversation, cycle's not bottomed. We still have further downside to go. It's really just that simple. And like a slow motion sort of train wreck, this isn't going to happen all at once until it probably does happen all at once, but it's like death by a thousand cuts. We'll continue to see large indices, Australian stock market, other stock markets continuing to drift lower as, in particular, I think, as companies come out, announce earnings, and guide down. I mentioned this in my last market update. So let's just quickly talk about inflation and what is likely to occur, what the data is saying going forward. So probably inflation's not going to really start to subside until the middle part of next year. inflation has been stubbornly high, as evidenced by the fact that it did come down quite significantly initially. It came off, I think, a 9% print in the U.S., got down to about just under 3%, but then re-accelerated. The same thing happened in Australia. We were, I think, up around 7 or 8%, somewhere in that range, maybe 9 as well. We had a deceleration down into the fives, and then all of a sudden we re-accelerated. You may recall that happening earlier this year. And that would have been off the back of energy and oil prices elevating in the middle part of this year. I've also talked about that in previous market updates. So what's happened with oil and some of the other commodities? Well, interestingly, oil has sold off big time. And I've just got a chart of oil. We've seen WTI go from roughly peaking around $83 a barrel in the latter part of September, now sitting at around $71 a barrel as of yesterday's market close. That's a pretty significant drop in the price of oil, and it leads into, this conversation leads into the quad outlook for the remainder of this year, so November and December, and then the first quarter of 2024, and possibly even the second quarter. But what we're looking at here is getting back into that quad 4 environment where everything is going down. So the fact that the commodity complex, and in particular oil, is not signaling or is not staying elevated in terms of its pricing and maybe going higher, is a clear indication that the market, and in particular the energy market, is discounting the fact that we're going to have any sort of economic growth or any sort of cuts in interest rates. So just to contextualize that for you, the moment the Fed announces rate cuts and the RBA announces rate cuts sometime next year, probably not at the earliest, I wouldn't think, until the third quarter, which will be on the calendar year, so the September quarter. I don't think we'll see a rate cut until then, unless something really catastrophic happens. We will then see the price of oil shoot higher because the U.S. dollar will start to come down. So we've seen dollar strength, interest rates rising, and now we're seeing the commodity complex starting to break down. And what that is really signaling is slower to no economic growth. We'll probably start to see that flow through to employment data, where in spite of the fact that the labor market numbers seem to be holding up, there's a lot of revisions that take place in the background. So we, in the U.S. in particular, we're seeing revisions to the labor data that gets reported. And what that means is that the unemployment rate is probably worse than is actually being reported on the headline, but it is one of the key metrics that the U.S. Fed does actually look at. So let me just wrap all this up into a nice little bow, because I think that's probably one of the reasons why you listen to these market updates, is to go from maybe the granular stuff that I've been talking about to a more high-level view of where we're headed. So again, we are still looking at further downside in terms of economic activity. Inflation is going to be stubbornly persistent. I want to say high. It's not high, but it's going to be stubbornly in that probably 3 to 4 percent band, at least in the U.S., and maybe 4 to 5 here in Australia, with a possible reacceleration. And even if it doesn't reaccelerate, it's not going to come down to the level that they want. This is going to confound the central banks a little bit. It's going to frustrate them, and they're going to then go back to the one tool that they really have in their toolbox, which is to raise interest rates again. Now, when that occurs is going to be the question. So in some of these articles that I've got here on the screen, there's a lot of commentary coming out from the participants in the market, particularly the mortgage industry, saying, well, some people are seeing the possibility of another rate hike in December or February. Excuse me, the RBA doesn't meet in Jan. And I have my doubts. I think that Michelle will likely wait to see what happens with this rate rise, and we'll probably wait to see what the Christmas spending and consumer spending do. There's no doubt this is going to put further pressure on budgets, because anyone with a mortgage is now going to, who's on a variable rate that is now going to be faced with an additional increase in their mortgage repayment. That's going to take money out of disposable incomes, which then has a flow-on effect to spending elsewhere in the economy. For those that are trying to buy homes, it's going to mean, for many of them, if they were right on the cusp of borrowing, it will mean that their serviceability will be impacted. So we're going to, I think, continue to see some pressure in the housing market, and certainly a rate rise should continue to sort of dampen the outlook for property price increases. We'll just have to see, though. It's that's one of those funny things in Australia where, despite the fact that interest rates have been rising, the housing market's actually not been too bad and has held up relatively well. Don't know exactly why that might be the case, but in any case, that is what's happening out there. Will this be the final straw? Have we not had a huge mortgage reset enough time? Excuse me. We have had a mortgage reset where, as many of you know, I've talked about the fact that a number of people are coming off fixed rates, and that has been happening since really around June of this year. We're probably yet to see the full effect of that, and won't see that until even December or January of 2024, insofar as it does take time for people to feel the impact of a higher interest rate. So to give you an example of that, I'm dealing with clients right now who are coming off of interest-only periods and fixed-rate periods, and their interest rates are almost doubling in terms of what they have to service on their loan. That may not have an immediate impact, as in that month that it happens, but it will have a cumulative impact over time, and that's especially true for those who might not be on huge incomes and don't have a lot of disposable income to absorb those mortgage payments. I hope that makes sense. So broadly speaking, what I'm saying to you is we're going to have continued slowing, and then all of a sudden, I don't know when, a few years back, I think it was 2018, we saw a market crash in December. I'm not saying there's going to be a market crash in December, but the market's kind of setting up for something, I think, dramatic to happen late November, maybe at some point in December. We'll just have to see. There could be some catalysts for that. One might be the Fed doing something in the next couple of weeks in terms of interest rates. We do get an inflation print next week, I think on the 14th, which might be a Wednesday. No, excuse me, that's Tuesday or Wednesday. I think we get the inflation numbers out of the U.S. So, we're just going to have to wait and see what the data says. But the market is now seemingly discounting that we're going to see further downside coming. The holdouts, of course, are the Magnificent Seven stocks, which are, the big names. The Magmant, I think, is the acronym now. So that would be your Meta, Google, Netflix, Tesla. Did I say Amazon? I think I did. Microsoft, Apple, and I may be missing one. But anyway, those are the big, huge market cap companies, which, interestingly enough, the market cap of those 7 stocks is something like double the market cap of the Russell 2000. So I think the market cap of the Magnificent Seven is something like $4.5 trillion, and the market cap of the Russell 2000, which is 2,000 stocks, is something like $2 trillion, $2.5 trillion. It's just mind-boggling that there's that much market cap in those huge companies, those tech companies. And it probably suggests that there's an adjustment that's going to be coming down the pike in terms of their valuations. So I think that's probably about it right now for this market update. It's really just right now waiting and watching to see what the market does. I've gotten out of energy for the most part. I've sold off Japan. Japan is now reentering a sort of more of a quad 3 outlook, and even India is about to get punted because it's not. It will likely succumb to any big market turbulence that occur. So it's really just going to be cash. I'm going to start reallocating to gold because at some point when the Fed starts to either do quantitative easing again or just begins cutting interest rates, you're going to see gold have a moonshot. And so now is a good time. Actually, gold has been under a little bit of pressure lately. but is has got very low volatility, and so it's a good asset to be accumulating here. And that also goes for platinum. Not silver, unfortunately. It's in a bear market. Silver's more of an industrial metal for those of you who follow the gold and silver story. Silver's a little bit more of an industrial metal than a monetary metal. And I guess on that score, on terms of volatility, I might just mention for any of you now who watch the VIX, because I talk about it all the time, this is the measure of volatility of the S&P 500. The VIX has closed yesterday, or yesterday, at 14.81. So 14.81 is the VIX. Now, you may recall, many of you who've been listening to this for a long time and watching this for a long time, that the VIX in that range is actually supposed to be investable, funnily enough. And so, and I've said it before, and I'll just remind you that there is some weirdness going on in terms of the volatility space, and the fact that vol seems to be at the moment being suppressed in some way. And there are ways that market participants can suppress volatility. But like a ball underwater, what eventually happens is when you let that ball go, or when the ball is let go, there is a huge upshot, a huge and violent movement to the upside. Now, again, I don't know what the catalyst will be for that. Who knows? It could be breakout of hostilities with Iran. It could be something to do with Russia. It could be something to do with the Ukraine, or maybe some other problem with the conflict going on right now in the Gaza Strip. It could be a breakout of some violence elsewhere in the world. Who knows? Or potential of war. Or it could be something in the financial system, like a major financial institution that goes bankrupt. We just saw WeWork. For those of you who are familiar with WeWork, they're a company. There's a great Netflix program about them. But they were a company that basically created workspaces, and that's where you go and do the sort of serviced office type thing. But in any case, that company just went bankrupt. So are we going to see more company bankruptcies? Is there going to be a high-profile bankruptcy that all of a sudden, triggers some chaos in the financial system? There's so many things that are lurking around out there that it could be any number of things, and it could be a bunch of things happening at once. We'll just have to wait and see. But for now, what I would caution you on is that the market is very fragile at the moment. The breadth of the market, meaning the number of stocks, for example, that are making new all-time highs versus new all-time lows, is way skewy. In other words, more stocks are going lower than are moving higher. The concentration of the stocks moving higher in the stock market is very limited. I talked about this, I think, over the last couple of updates that I've done. So the market structure in and of itself is not conducive for making money right now in stocks. So the approach will be to be conservative, raise cash, sit in things with lower volatility, and pick spots to try and make some money here and there. If you do have any questions or you'd like to schedule a meeting with me, you can do that by going to a book a meeting link. That's there is one in the Facebook group. If you're in the Facebook group, the boardroom. If you're not in that and you have a Facebook account, please send an invite to join that group. So it's called the boardroom. You can find that. It should be somewhere under Intrepid Wealth, floating around in Facebook. If not, just email team@intrepidwealth.com.au, and we'll make sure we get that fixed up. Likewise, you can, for any of you who get emails from me, you'll see a book a meeting link in the footer of that email. You can book yourself in. Just a quick message regarding travel. I will be traveling to the U.S. on the 15th of November. I'm going over to visit family for Thanksgiving. I'll be back on December 1st. I will be working, and because I'm over there in the U.S., I'll be trading, or not trading, but I'll be monitoring the U.S. stock markets and making any necessary movements while we're there. There's a few holidays in there, so there's usually on holiday periods either the markets are closed or there's reduced trading time or trading hours. So in any case, I will be contactable, but obviously I'll have that blocked off on my calendar so that you cannot book meetings for that period of time. But if anything urgent comes up, please just email me and let me know. Other than that, have a fantastic rest of the week. I'll update you if there's any major developments over the next few days. I can't imagine that there will be, probably not until next week when we start to get some U.S. economic data coming through. And I'll certainly be leaving market updates whilst I'm away. I'll do one probably later next week once I've settled down and have completed my travel and get a gauge of what's going on in the markets. For now, I'll say have a fantastic weekend and talk to you all again next week. Cheers, everyone. Bye.